Here's the question I get asked the most. At what income level should I go limited? And typically people talk about 3 different bands. So you've got 0 to 30k, 30 to 60, and then over 60. And I'll give you my opinion on them. Your 0 to 30 profit, 30k of profit, it almost always makes sense to stay a sole trader. 30 to 60 is a bit more of a grey area. It more depends on your situation, not the income. And over 60k, it does start to make more sense to go limited. That 60k point used to be an absolute slam dunk of tax savings. People used to think that that was the point to definitely go limited. 3 things have changed recently, which has just shrunk that benefit so much. Dividend tax has gone up to 2%. You've got employers' NI, which has gone up as well. And then the threshold at which you start paying employers' national insurance has also shrunk. So you start paying that a lot earlier. Now, if you're a one-man band as well as a limited company, you're not entitled to the employer's NI allowance as well, which would normally soak all that. When you take those 3 things into account, there's almost no difference. So let's kill the biggest myth first. Having a limited company saves you a load of tax. Let's look at 2 different scenarios, and I'll break down with actual numbers what you're left with as a take-home pay when you consider being a sole trader against a limited company. Let's take someone firstly earning £30,000 of profit. As a sole trader, you're going to be exposed to 2 different types of taxes. You've got income tax at 20% at that level, and then class 4 national insurance being at 6%. When you take those 2 taxes into account, you are left with a take home of $25,500. Now, let's look at the limited company side of things. Taxes to take into account: corporation tax at 19% at that level. You've got employers' national insurance on the salary that you'd have, and then you've got dividend tax to take into account as well. All of that taken into account and extracting all of that money from the company, your take home would be £24,400. That's £1,100 worse off than being a sole trader. Now let's bump it up to 60,000. And this is where people typically say limited company always wins, like surely. So because we are at 60,000 now, the tax rates are going to change slightly. It's not as simplistic as it was before. A proportion of that profit will be taxed at a higher rate. As a sole trader, your take home would be £46,100. And as a limited company with that same level of profit, it would literally be £20 less. And that is even before paying an accountant, where your limited company, there's naturally more compliance work, more things that the accountant needs to be involved in, and therefore your fee is going to be higher. So where does this famous limited company tax advantage actually come from? If you are rinsing the company for every penny that you earn, the advantage isn't going to be there. You may as well be a sole trader, other than the risk side of things. A lot of people say set a limited company up because of that risk protection. And I'd say that that's the main advantage from having a limited company now, the personal protection element. The actual win from having a limited company is being strategic about it. So if you are not taking everything out and you're leaving profits in the business, you're going to pay your flat corporation tax percentage on the profits that the company has generated, but then you're only going to pay the additional tax on what you extract from the business. So if you're wanting to leave money in to reinvest back into the business and actually grow that business, then the limited company can be a really good option. As a sole trader, if you're earning £100,000, say, but 50k of that you put in a savings account, you're getting taxed on all of it as though you've earned that 100k and just pissed it all up the wall anyway. When you have a limited company, there's a bunch of cool things that you can do as well. Typically, it's not the structure that saves you tax, it's what you do within that structure that will save you tax. A few things like contributing into your personal pension from your limited company. If you do that as a sole trader, you get tax relief, but when you do it straight from your limited company, it literally reduces your profit on paper, meaning your company pays less corporation tax. So it is a big difference. The other benefit that comes to mind is if you have a spouse as well and that individual has shares in your business, you can then be flexible with how you split the dividends up. If they've got an unused personal allowance, you can take advantage of that. Myth number 2 with the whole limited company side of things is having a limited company protects all of my personal assets. So let's get into that. So yes, limited liability is a thing. If the company racked up a load of debt and it failed, then what you would typically do is liquidate the business and creditors can't come after you for what they are owed. And that is a genuine advantage, and that does happen. But there's 2 things to consider. 1, when you get a loan, you take a new card out. Sometimes, especially when you're early on in your business's journey, you can only get access to that if you sign personal guarantees, because creditors are very aware of that limited liability and they need to be protected themselves. So with that in mind, that limited liability aspect that you might have had in your head is now disappeared. If the business was to commercially fail, then you would still be personally liable for those debts. Number 2 is the whole limited liability approach only protects you for if the business commercially fails. If it's down to your negligence, or you've done something fraudulent, or you've just not acted in the best interest of the company, there is a concept called lifting the veil of incorporation, where you can still be personally liable for all of the debts that that company owes because of your wrongdoing as a director of that particular company. So with those things I mentioned in mind around the whole risk side of things and limited liability approach, that is just proof that having a limited company is a useful shield in some cases, but it's not a force field. Here are some of the hidden costs that when your friend said just set up a limited company, they didn't tell you about these. The first one being accountancy fees. Right, as a sole trader, you just have a once a year personal tax return to do. Of course, this is changing with Making Tax Digital coming into play. You'll have 4 quarterly submissions and then still that final tax return to do. So the compliance burden is increasing slightly on sole traders. With a limited company, you've got company accounts with Companies House to file every year. You have a company tax return to send to HMRC. You have an annual confirmation statement. You've got monthly payroll. You've potentially got quarterly returns, and you still have that personal tax return to do. So as you can see from that, so much more compliance work that goes with a limited company, and therefore naturally your accountant's fees would be so much higher. The biggest hidden cost isn't a number. When you have a limited company, it's now not just you, right? You're running a business. It's difficult with knowing what to do with your cash, whether you can, whether you can't take it all out. So there's more compliance now. For some people, this can be really empowering. For others, it's just a headache that they didn't sign up for. With all that in mind, when should you go limited? So here's my view on it. If you leave profit in the business, then you're only getting taxed that additional rate or additional amount on what you take out of the business. If you want to regularly contribute into your personal pension, a limited company is a really good vehicle to do that from. If you have a spouse that maybe has or isn't utilising their personal tax allowance, it can be a really good vehicle to be tax efficient and split the dividends that you take out of the business amongst 2 people to keep the income below the higher rate threshold. If you genuinely need that liability protection, so let's say you're going into what is deemed to be a riskier industry, if you knew from the off that cash flow was going to be your biggest barrier to having a successful business and you needed to get some debt financing in, then perhaps it would be good to set up as a limited company, because if the business commercially failed, then you are personally protected unless you've signed a personal guarantee. And the final one being credibility with clients. We do live in this world where if you're tendering for contracts or you typically work with businesses that are bigger than you, people do have this perception that if you are a limited company, you're almost more serious as a business and therefore more credible as someone to work with. So honest recommendations without sitting on the fence. If you are earning 30k or less, I do think it's more simplistic to stay as a sole trader, dependent on the sector that you're in and whether you're getting any debt financing into the business. If you're between 30 to 60k, don't decide on income alone. Think about whether you'd want to be leaving profits in the business, whether you want to contribute into a pension, whether you want a business partner or a spouse involved in the business. Over 60k, go limited. If you're serious about your business and you do want to grow something for your future, I do think it's a really good vehicle to do that in, but have an open mind to the higher admin costs of running that business and the additional compliance burden. So if you want me to do the deep dive on how to extract money from a limited company in the best way, we're talking salary, dividends, pensions, the lot, let me know in the comments and I'll throw something together for you guys. And if this video saves you a bad decision, this is what the channel's for. I'll see you on the next one.